Hi, I'm Siu Ling Hui with part 10 of a video series about how your financials can help you manage and drive business success. In this video, we'll look at a common challenge for fast growth businesses, financing the working capital requirements that come with growth. In part 9 of this series, we considered the use of debt versus equity as a means to fund business growth. We covered some of the key factors to be considered in assessing how much debt a business should have. In that video, we used the example of financing equipment purchases. In this video, we are going to look at financing working capital requirements. Many fast growth small businesses often find themselves struggling to find enough cash to pay the bills. This cash shortfall is because payment of expenses and suppliers often outpace the conversion of sales to cash. Businesses that properly plan and manage their growth funding needs are the ones that will survive. Properly considered financial forecasts are essential for planning and managing successful business growth. Forecasting is not about predicting the future. Rational forecasting is based on realistic assumptions about likely future outcomes. Your assumptions are a reflection of your business and marketing strategies and your expectations about business and economic conditions in the forecast period. For this example, we are going to do a 3-month forecast. However, the same principles demonstrated here apply to preparing annual budgets. In this instance, our forecast runs from November to January, so we need to factor in seasonality issues. Let's start with the profit and loss. Here's the forecast profit and loss for November through to January. We expect sales to grow strongly over November and December and then drop back down in January. We are going to be doing more marketing activities to drive these higher sales. So we might have additional advertising costs, printing costs, higher phone bills, and so on. So let's say our general and admin costs increase over November and December, but drop back down to the October level of $3,000 per month after that. We anticipate we'll have to pay overtime to our staff or hire additional casual staff in December. So we'll have a higher wages bill for December. Now, the profit and loss doesn't tell us anything about cash flow. We've got to do a cash flow forecast to figure that out. To forecast our cash flow, we have to make assumptions about the cash conversion cycle of our business. How much stock do we have to order? When do we have to pay for it? How much stock do we have to hold to achieve our sales? How long will it take for us to collect the money from our sales? And so on. There are 2 ways of forecasting cash flow, direct and indirect. With the direct method, we have to figure out all the cash inflows and outflows for our operating, investment, and financing activities in the business and then create the balance sheet. With the indirect method, we build the balance sheet out based on our assumptions. Then we create the cash flow statement using the net profit as a starting point. After that, we incorporate the changes in the balance sheet to derive the cash flow. This is how we've been doing the cash flow statement in all the videos in the Cash Flow Kung Fu training series. Now, you may be wondering, what has the balance sheet got to do with cash flow forecast? Look, to get a full picture of your business, you must always have the 3 financial statements: profit and loss, balance sheet, and cash flow statement. And these 3 statements must synchronize with each other. Otherwise, it means your financials are wrong. You don't want to be making business decisions based on incorrect information. Financiers also insist on seeing 3-way forecasts. We are going to use the indirect method for forecasting our cash flow. We've done our profit and loss forecast based on our assumptions about expected sales and expenses. The projected net profit will feed into the balance sheet and cash flow statement. Now let's develop the rest of our forecast balance sheet based on our assumptions about debtor collections, inventory lead times, creditor payments, and so on. Once we've done the balance sheet, we'll be able to derive our cash flow forecast. The net cash flow figure that falls out of the forecast cash flow statement will be reflected in the cash balances in the balance sheet. Here's the asset side of version 1 of the forecast balance sheet. Forecasting is an iterative process. We do the first cut of the projections to figure out how much cash we're going to need. And then we work out how we're going to fund the cash shortfall. And then we incorporate that funding into our projections and have a look at the revised projections. The cash line is the result of all the assumptions we make about expected credit and cash sales, debtor collections, inventory purchases, payment of creditors, taxes, financing, and so on. The cash balance is negative in December and January. That means we don't have enough cash to fund the business in the forecast period. Let's take a look at working capital items, starting with debtors. We are forecasting big increases in sales in November and December, followed by a slowdown in January. 80% of our sales are on 30-day credit terms. But based on what we know about debtor collection patterns in recent times, we think it's realistic to assume that only 20% of those debtors will actually pay on time. The rest of them will pay somewhere between 30 and 60 days. So in our forecast, we work out what our debtor balances will look like at the end of the month based on this collection pattern. Now let's look at inventory. Inventory planning is really important for a business. You don't want to be holding too much stock because that ties up cash flow, but you don't want to run out of stock either and lose sales. Based on our forecast profit and loss, we know how many units we expect to sell in the forecast period. What we need to figure out now is timing issues. What is the lead time we have to allow for stock delivery from our supplier? How much stock do we need to hold to have enough to meet our projected sales? Over September and October, we've been ordering inventory every 4 or 5 days, but our supplier has told us that we have to start holding more stock. With the busy holiday season coming up, our supplier cannot turn orders around so quickly. He needs about 2 weeks. Our supplier has also told us that he's closing the factory from Christmas until late January. He'll make last deliveries between 27th and the 30th of December, but there'll be no deliveries after that until late January. Based on what our supplier has told us, we'll ramp up our purchases in November so that we hold about 15 days of stock on hand. So our stock holdings will jump from $6,286 at the end of October to $53,714 at the end of November. As we won't be able to get stock through most of January, we have to plan to have enough stock on hand by the end of December to see us through January until our supplier starts delivering again. So we figure that we probably need to be holding around $67,000 in inventory at the end of December, which will run off during January. By the end of January, we expect to be holding about $22,000 worth of inventory. Now let's turn to the liabilities and equity side of the balance sheet. We'll still get 30 days credit terms from our supplier and we'll pay on time. Our supplier is closing his factory and distribution functions over the holiday season, but he'll still be chasing his accounts, so we expect to have to pay for December orders sometime in January. However, we are not expecting to place any orders during January, so trade creditors balance will be zero by the end of January. With tax payments, let's assume that the tax office allows an extra month for quarterly tax payments at this time of year. This is what happens in Australia. For those businesses which file and pay quarterly, the tax payments for the December quarter is usually due at the end of February. Now we can construct the first cut of the forecast cash flow using the forecast profit and loss and balance sheet. Let's start with the cash flow from operating activities. The projected business growth is chewing up a lot of cash because of the build-up of debtors and inventory. In November, the impact of this cash flow drain is offset by the increase in trade creditors. December is the peak trading month in the forecast period. Profit is at an all-time high, but so is the need to fund working capital. Based on our assumptions about debtor collections, we expect to receive payment from November credit sales during January. These are the debtors who usually pay us somewhere between 30 and 60 days instead of 30 days. Those collections will exceed the increase in debtors from January credit sales. So that's a positive cash flow effect from debtors this month. Likewise, we are running down inventory during January. So that's got a positive cash flow effect as well. But we have to pay our supplier for the December purchases. This cash outflow more than offsets the net cash inflows from debtor collections and inventory rundown in January. We won't have to make our December quarter tax payments until February, so taxes have a positive effect on working capital this month. So overall, operating activities in January is still chewing up cash, but not as much as in December. Now let's look at the investment and finance activities section of the forecast cash flow statement. We are not planning to buy or sell equipment or other fixed assets in the forecast period, so cash flow from investment activities is zero. We have to continue to make interest and principal repayments on the existing financing facility that we used to fund the purchase of a forklift, so that's more money going out. As you can see, that is negative net cash flow right throughout the forecast period because our operating activities are chewing up cash flow. Our bank balance is very low at the start of the forecast period, only $4,942. And at some stage in December, we won't have enough money in the bank to fund the business, as you can see from the negative closing bank balances. Based on the monthly forecast, we'll probably need to borrow about $71,000 to get us through to the end of January. Even then, we'll have very little money left in the bank. So let's say we arrange for a working capital financing facility of $80,000 to cover us during the forecast period. We'll assume that the interest rate is 10% per annum and we pay interest monthly in arrears. That is, we pay interest at the end of the month. So let's now go and incorporate this debt financing into our forecast numbers and see what happens. Here's the revised profit and loss. We expect to start borrowing money under the working capital financing facility in December. The main impact on profit and loss is higher interest costs than in the first cut of the forecast. That reduces profit before tax slightly, and accordingly, provision for income tax will also reduce. Let's take a look at the balance sheet, starting with assets. The bank balance is no longer in the red because we've borrowed enough money to fund our working capital requirements and allow for small positive balances in our bank account. That new financing shows up on the liabilities side of the balance sheet. We've now got new borrowings, which we'll just call working capital facility, as part of current liabilities. Although we are assuming we have an $80,000 financing facility approved by our bank, we expect to only owe $55,000 under this facility at the end of December. We expect that the amount owing will increase to $77,000 by the end of January. So we'll still be within the facility limit with a little bit of room for error. Now let's look at our revised forecast cash flow. There's no change in the net cash flow from operations from version 1 of the forecast. The reason is that interest expense is backed out from the net profit figure when we are working out the net cash flow from operations figure. There's no cash payment of income tax in the forecast period, so the reduced income tax has no cash impact. It's in the finance activities of the forecast cash flow statement that we see the impact of the financing decisions. Borrowings made under the working capital financing facility shows as cash inflows under financing activities. Note that it's not the facility limit of $80,000 that goes into the cash flow. Only the amount that we actually borrow that month is shown as the cash inflow. Cash outflow from interest payments over December and January will be higher as we've got additional debt in those months and we have to pay interest monthly. This cash inflow from borrowings in December and January enables us to finance the cash flow deficit from operations. As a result of the cash inflow from borrowings, the overall net cash flow for the business is positive in December and January, and we borrowed enough to ensure that we have a small positive bank balance at the end of each month. Version 2 of the forecast is only indicative of the potential funding requirements of the business. In forecasting, it's essential to do what-if analysis to assess other likely future outcomes before we make any final decisions about our business and financing strategies. For example, when do we really need to have the financing in place by? The forecast monthly cash flow numbers suggest that we don't need to borrow any money in November. But will that really be the case? We had $4,942 at the start of November. That looks as if it's more than sufficient to cover the forecast net cash outflow of $1,388 that month. But what if during the month of November, we only received most of our cash inflows towards the end of the month, but had to make most of our cash payments at the beginning of the month? If we don't have the financing facility in place by the beginning of November, we'll probably find ourselves in a cash flow crisis by the middle of the month. Will an $80,000 facility limit be enough to cover any intra-month cash flow deficits in December and January? We should be doing weekly cash flow forecasts for the forecast period to find out if there are potential intra-month funding peaks that exceed $80,000. Also, we should test our assumptions. What if our debtors pay us more slowly than we have assumed? What if sales are lower than expected? What does that do to our forecast funding requirements? There are other issues we also need to consider when we are planning our financing strategies. What kind of financing facility or facilities should we use to fund our working capital requirements? How much debt should our business have? Would a financial institution approve a financing facility for our business? We'll cover these issues in the next few videos in this training series. Let's do a quick recap of what we've covered in this video. A forecast profit and loss is only the starting point in business planning. Sales and profits are not cash. You must also assess the related forecast balance sheet and cash flow statement. This is the only way to properly assess what financing is required to achieve your business objectives. Financiers also require you to provide three-way forecasts. There are two approaches to forecasting cash flow: direct and indirect. We use the indirect approach in this video. Forecasting is an iterative process. The first cut enables you to assess what the potential financing requirement is. Then the potential financing decision is incorporated into the forecast. The forecast must then be reassessed as to whether the proposed financing decision is feasible or acceptable from a risk standpoint. Forecasting is not about predicting future certainties. You need to make assumptions about the future. Financial forecasts must be based on realistic assumptions in order to be useful business management tools. It's also essential to use what-if analysis to assess the business impact of different assumptions. We'll go deeper into this important process of stress testing forecasts in a separate video. I would really appreciate your feedback on the training in this video. Please put any questions or comments below and I will respond. Master your cash flow, know your finances so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.